happy to be here. Been in Luxembourg over the last few days. It's been interesting. And as it happens, our holding company is also based in Luxembourg, so we're very familiar with Luxembourg. While he's just getting the presentation up. It's not really showing full screen. Very quickly, I was really happy to hear Karen's talk. We're an investor in Fedor Bank. Fedor Bank is the first bank in the world to use the Ripple protocol. And I'm also a member of the Swift Enablers Board, as my colleague here from Swift will know. And I've always said very publicly that I believe the blockchain protocol is the death knell for Swift. So Swift is actually working very hard to start to incorporate some of that stuff. And I think over time we'll see, but I truly believe it's revolutionary. It's going to change the banking industry. While the presentation goes up, let me introduce myself. My name's Udayan Goyal. I'm one of the founders of Anthemis Group. We're a digitally native finance company investing in early stage financial services companies around the world. We have 27 companies in our portfolio. We recently sold 2 companies, one called Simple to BBVA, the other one called the Climate Corporation to Monsanto, which did weather derivatives. We'll talk a little bit about that through the presentation. And what we're trying to do is really reinvent financial services, one startup at a time. So indeed, pretty much the speech, we believe in the future being distributed, a distributed company or a networked company, as opposed to being a company that is built top-down, which is pretty typical. So I think we're now in a position to start. So really, where are we coming from? If I take a step back, where are we coming from? The world has changed over the last, I would say, 25 years. And the biggest change that we saw as we go through different ages, so we're all familiar starting from the feudal landscape into the industrial age, into the age of electricity, et cetera, et cetera. But the really seminal moment for this generation and for people around this room was actually in 1971, when Intel invented the microprocessor. And that fundamentally changed basically the way we all live and the way we all are. Ushered in a new era of completely new industries, technology, the way we do business. And the next big change that really happened was in 2006. And what happened in 2006? Well, companies such as Facebook and others were born. And that heralded the age of information and the age of a very networked economy that we live in. And so this has fundamentally changed the way we think about business, the way we think about everything we do. And in particular, we think has fundamentally changed the way financial services is going to be transacted in the future. So if you think about a typical industrial economy, you typically think, and I'm going to use the IT metaphor of stacks, you typically think of something that's completely vertically integrated. So I often liken this to General Motors in the 50s. So if you think about General Motors in the 50s, GM had their own steel plants. They actually even mined some of their own iron ore. They were pretty much an end-to-end manufacturer that did everything and then got the car out to you today. If you look today at Toyota or any one of the big manufacturers around the world, what they do is they focus on the experience, the customer experience, and pretty much outsource everything else in the value chain to other people. And we think the same thing is going to happen to financial services. Today, financial services is a vertically integrated stack. We think that over time in this information economy, we're going to disaggregate that. And so there have been a number of trends that have been starting to permeate financial services. And some of them, and one of the big issues with financial services is that unlike most other industries, there are some very, very significant barriers to entry. Those barriers to entry are regulatory, typically. There's some very, very entrenched incumbents who are gigantic financial institutions that operate in pretty much every country. And as a result of the high degree of regulation, it's pretty hard for a new entrant to come in. So what's happened over the last 25 years is all the smartest people have gone to consumer internet because actually the barriers to entry are low, and that's where the entrepreneurs wanted to go. Now, one of the things that's really changed and has made some of the things that are happening today possible has been the global financial crisis, because consumers have been more open to trying something new. And indeed, regulators are pretty keen to create competition. We have a very active dialogue with all the regulators, both in the US, UK, and other countries, around how to actively encourage smaller companies to become competitive against the bigger players. And so this is not I wouldn't say this is a isolated incident. If you look at the transition from the industrial economy to the information economy, there have been a number of very well-known companies that have emerged. So whereas Kodak went bust, at the same time as Kodak going bust, Instagram was born and sold at a pretty incredible valuation. If you look at music, we don't think about music on cassettes anymore. We use things like Spotify and SoundCloud. If you think about how you navigate around, you use either a TomTom or now you use Waze, which recently Google acquired. If you think about how you lend money, you don't actually deposit it in a bank anymore. You use platforms such as Zopa, and et cetera, et cetera. So we're really, the way the business models are fundamentally changing in the information economy. But it's really, really important to note, and this is very, very important because most people think that it's technology that broke these distribution models. So the old distribution models. It's not technology that broke the old distribution models. Actually, it's technology that changed consumer behavior that broke the business model. And actually, if you look at what Amazon did to the book selling industry, it changed people's buying habits. Rather than walking down to the bookstore and walking and physically buying a book, people browsed online and bought a book online and had it delivered to them. And that was enabled by technology, but ultimately it was the customer behavior that changed. And that's what we're starting to see in financial services. So in banking today, if you think about it, the basic consumer needs are actually pretty much the same as they've been for hundreds of years. People need to save money, people need to spend money, and people need to transfer money, which is what we were talking about a little earlier. But what has actually changed has been expectations. And expectations have changed because people want to now participate in the process of actually doing those activities. So they're interested in co-creation, they're interested in network building, and indeed they're interested in pretty much mass-scale personalization. And actually technology is starting to make this possible. So if I start now to think about the 5 or 6 main trends that I'm starting to see in banking across the world and how you're starting to reinvent banking around these trends, perhaps the most interesting, starting point is around this concept of recommendation and co-creation. We always liken recommendation and co-creation around probably Amazon, where you leave Amazon feedback, or around potentially collaborating with people on various things. But we're actually starting to see that within financial services. And so there are a number of interesting companies. Of course, Amazon is a great example of something in a different industry, but eToro, which is one of our companies, very, very, very smart company, has 2 million customers, 100,000 actively trading every day. And the idea is that you can share your portfolio with everybody in the system, and they can follow your portfolio. So what I do on eToro is I put in some money, and I'm following the top 5 guys on the leaderboard. I'm making a return of about 10, 15% a month, which isn't too bad. And I'm doing that basically through this concept of co-creation. Same concept around TripAdvisor, which I'm sure a lot of you are familiar with. But the interesting thing is how it's permeating into the financial services world. Fedor is a fantastic example of co-creation. One of the things that Fedor did about a year and a half ago, I think, was that Fedor has about 300,000 members in their community. They call it a community. It's a kind of a message board where people share ideas and talk about finance and share things. And what we did with Fedor is we go out there and we said, you know what, we need to create a savings product. So why don't you first tell us about every single savings product you've seen. So in 3 days, we had a database of 6,000 savings products. Then we created 3 prototypes and said, prototype 1, prototype 2, prototype 3, which one do you like? And so people commented on the prototypes, voted on one, and the one that won, we put it out. And so we basically crowdsourced the entire product development cycle. And we launched it, and within a few months, we had 130 million in deposits using that product, which is pretty phenomenal for a startup bank of 29 people based in Munich. So it just shows you the power of, if you build the consumer into your thought creation, what you can do. The next trend is this concept of abstraction of complexity. Now, the guys who really pioneered this was Apple. Apple took away all the complexity that you see in a PC, repackaged it, put it in a great product, and everybody loves using it because you really don't need to know what MS-DOS or whatever it is at the back is doing in the background. All you want to be able to do is use your spreadsheet or browse the web. And in much the same way, most people are not really interested in the nuts and bolts of what happens behind the scenes in a bank. What they're interested is in the product. And indeed, around that is the focus on what we call UI and UX, so the user experience and the user interface being much simpler. So what you see up there on the screen is a typical statement on the left, which is your non-digital statement. And then on the right is basically a screenshot of the simple mobile product, which I think is, has beautiful UI. And indeed, another company that we've invested in called Betterment has built a 401k replacement savings product for the US, which essentially, that's the interface in front of you. So the most important thing is the thing you see on the left-hand side, right-hand side, which is the dial. You dial up the amount of risk, 0 to 100, and everything else gets done automatically in the background by investing in ETFs. 15 basis point fees, which is a fraction of what anybody else charges, completely liquid, instant access. So completely revolutionizes the way people think about long-term savings. As AUM growth at the moment in this company is like 20–30% a month. Phenomenal, because people are basically replacing their 401k programs with this. The next major trend that we see is around transparency. So consumers are interested in knowing and wanting to know how much money you make and how that actually integrates itself into pricing. This concept of black box pricing is not particularly popular anymore with consumers. And so if we think about it, retail banks have been particularly notorious in reveling in complexity. And one of the things that the US banks are particularly good at is tricking you into going into overdraft, because they make $40 billion a year on unauthorized overdraft fees. And they do that by basically showing a ledger balance, which isn't actually your ledger balance, because you have a settlement cycle which is longer than when they credit your ledger balance. And so you spend the money, and actually the money isn't there, and off you go and you pay your $50 fee. So, one of the things that Simple did was create this thing called Safe to Spend, which was how much money can I actually spend right now without getting myself into trouble. And that takes into account your typical monthly spending pattern, so it knows that your cell phone bill is coming in tomorrow, it knows that your electricity bill is coming in day after, and it'll tell you that this is how much you can spend without actually getting yourself into trouble. Really, really simple concept, super popular, because this is actually what people need to know. They need to know how much money do I really have when I take into account what I need to spend and what's out there. The next one is actually data. So we've been talking a lot, I'm sure, about data and big data. I mean, this is truly a revolution. And one of the things that we're starting to see is this concept of data becoming a new type of raw material. It's on par with capital and labor. That's the World Economic Forum quote. And at the end of the day, electronic money is just a form of data. Now, Moven, which is another one of the companies that we work with and we've invested in, which is founded by Brett King, who's the writer of Bank 2.0 and now Bank 3.0, actually uses data in a very clever way. It creates this concept of knowing what your financial wellness is. So what you see there, that little dial, shows you whether you're in the green, yellow, or red. So relative to your usual spend, are you overspending, underspending? And if you're underspending, it encourages you to take your underspend and put it into a savings account. So this is real time, and the beauty of this is it's completely real time. So you walk into Starbucks, swipe your card, or use the NFC mechanism, and it's an app running on your phone, and it'll immediately tell you, you've spent $250 in Starbucks this month. You should actually only be at $225, be careful. So it really gives you that real-time feedback about your spend habits, and this is what people are looking for. As a result of that, typical transactions going through a card in the US is 1.7 transactions per week. At Moven, we do over 12 per week, and each transaction is where we make money. So, this has real economic benefit as people think about it. And actually gives you long-term feedback, so that's your spend trajectory over a month. So it shows you how your spend trajectory over a month. So it really allows people to manage their money. Lifestyle integration. So this one's quite interesting because I always say, what people are focused on is multi-device, multi-channel interfaces. So true omni-channel banking. true omni-channel banking just doesn't exist today. It's all like a bit of an add-on, so it's coming there. And actually, what I always encourage people to remember is that consumers actually don't buy a mortgage. It's not like you wake up in the morning and you say, today I'll buy some travel insurance or car insurance, so it's a good day to go out and get a loan. Actually, what people are doing is saying, I'm going to buy a house, or I'm going to buy a car, or I'm going to buy a holiday, and then they think about these add-on products around it because it's integrated into that. And so lifestyle integration becomes very interesting, and Climate Corporation that Monsanto just bought is very interesting because what Climate Corporation did was create an end-to-end platform for farmers in the US to manage everything from planting to seeds to yield management to comparative to looking at rainfall, and then the product that they sold was weather insurance on the back end of it. So what they did was allow you to manage everything end to end and integrate within that the actual product. And real-time feedback. Now this is something that unfortunately financial institutions haven't done terribly well at all at. And they're starting to get better. You know, that's an overall, this is actually an overall aggregation of customer satisfaction across the board. And looking at all those themes, I'm just going to, now, just before you press play, this is a song that somebody put up about Simple on the web, unprompted. So if you could just press play.
I hate banks, they're greedy and evil. They got us into this mess. And I feel bad with my money in a bank that was bailed out like the rest. Too big to fail, it's wrong, so let's get our money out right quick. Cause there's another way that I heard about, so I think it'll do the trick. Simple, simple, they treat you like a human. Simple, simple, they wanna help you with what you're doing. So well designed, they never profit from fees. Your data is there so you can budget with ease. Simple does all the things right that have been done wrong for so long, that you just kinda thought that was how it was. But with Simple, all the crap is all gone. You call them up and you talk to a person who's full of warmth and excitement. No overdraft fees or hidden fees, low balance fees. They just want to do it right. Man, simple, oh simple.
So,
Design well from the start.
there we go. So, what you see there is some real-time feedback. That's like the best manifestation of it. But of course, you can get it other ways. That's a Twitter feed. So I think on one side you see the Citibank Twitter feed, on the other side you see the NetBank Twitter feed, and Twitter's become a real two-way interaction amongst consumers to really think about that. So that's been pretty interesting. So people are really interested in doing that, and it's very important to interact at that level. So, you know, those are some, and then the final piece is, of course, behavioral economics and gamification. We talk about this a lot now. And one of the things, one of the companies, again, that we have is a company called PayPerks, and what they're doing is working with the unbanked and the underbanked consumer in the United States initially, who today get paid you can't really pay people in cash anymore in the US. You give them something called a payroll card. The problem with people who get a payroll card is they go to the nearest ATM and they take all the money out. And that's a bad economic model for the payroll card guys because they make money every time you swipe it in a point of sale or keeping the money on there. So what this is a very simple concept. It's a bunch of sweepstakes. So every time you use the card at a point of sale, it enters you into a prize draw. And at the end of each week, it's $1,000. Somebody wins that. And in the pilot, we had an 80% adoption rate. And now it's being rolled out with both Visa and MasterCard right across the country, which is fantastic. Because what it's doing is actually creating, in its own way, financial inclusion. So very interesting, and that's about behavioral modification. So we're actually changing behavior, consumer behavior. So, you know, these are some of the big themes, and these are some of the startups that are doing that. And I think, you know, one of the things I love what, you know, Brett and I talk all the time, and this was one of the things he said to me because I thought, actually, I really like this. He's, you know, regulators actually don't regulate customer behavior, and they're never going to. And I think it's always important to remember that, whether you're a regulator or whether you're in the market. And then finally, you know, what does all this mean for the industry? I mean, I talk about all these things. What does all this mean? What's the real economic issue around it? And actually what's interesting is that it completely transforms, we think, 4 of the most important metrics in financial services and in banking. And those 4 metrics are actually the cost of acquisition, the cost of customer acquisition, the cost of distribution, the scalability of a platform, and the cost of underwriting. And if you look at the cost of acquisition, today at Movin, we can acquire a customer at $50 a customer. The industry average is somewhere between $400 and $900 a customer. That should scare banks, because that means I can get a customer and be profitable pretty much in a month, whereas it takes a normal bank 2 or 3 years to reach profitability on each customer. If you think about scalability, you know, Fedor, as I told you, runs on 30 people in Munich with 300,000 customers, 50,000 full KYC customers, and can be very, very profitable with very, 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 very few customers relative to an 11-year-old global e-wallet provider on the right-hand side, no points for guessing who that is, who has 17 million accounts and struggles a little bit with profitability. And indeed, there are some fundamentally different competitive advantages that you think about in an industrial economy versus an information economy. And these were some of the points we talked about around organization being distributed, the context being abundance, you know, success factor is actually talent as opposed to financial capital. Value proposition is all around the consumer experience. And the objective is resilience as opposed to scale. And you can do that because now you can rent from Amazon Web Services infrastructure. So you don't even need to build your own infrastructure, and it's pretty resilient. So that's a little bit about Anthemis. Anthemis is a network of companies. It's a network of knowledge, and it's a network of people, and we help people do that. This is we sort of bridge between the startups and the big companies, help the big companies navigate this new world. And I always love this chart. That's a little representation of our ecosystem. And I'm gonna finish up with a video I created a couple of years ago. I'm showing this video because it was inspired by a guy you're gonna see tonight at the dinner, for those of you who are going, a guy called Ron Silva, and Jason Silva. He actually inspired me to do this, and I'll play that for you. And thank you. The multiple financial crises, the pervasive hubris and selfish attitude of the incumbents, the widening gulf between the rich and the poor. These are some of the themes that have led to the dislocation of the financial services industry, originally prompted by a combination of lax regulatory oversight, the over-leveraging of wholesale markets, and the decay of prudence. We've also seen the atomization and deconstruction of core banking functions. However, we're at the dawn of a new age being led by a new generation of technologically powered, socially connected generation of entrepreneurs and consumers. The entrepreneurs seek to provide a superior service, beautiful aesthetics, user-centric design, and distributed business models for the discerning 21st century consumers, who now have higher expectations. They want personalization, they want recommendations, they want reviews, they want peer feedback. And the mantra is, let's have a dialogue so you can meet my needs and expectations. Let's co-create. Be transparent, show me the evidence. We're a collective, a swarm, leaderless but effective, bound by a common purpose. We value integrity of the person and the product. If I like what you do, I will be your evangelist. New social media platforms, which are both fragmenting and empowering consumers, have majorly fueled this new awareness and interaction. This is ushering in an era of cultural change, with the re-emergence of the tribe, with its own local language in a highly connected world. For the first time, we are seeing the adoption of technology by consumers, superseding that of businesses. We're also seeing the emergence of peer-to-peer networks in the financial services arena that seeks to disintermediate traditional institutions. At the same time, there are pioneers who are using behavioral economics and gamification to innovate in the mainstream, as well as to solve the issues of financial inclusion and education. Today, data is the new oil. We can now collect and analyze data in real time at almost no cost. There is a democratization of data, where the use of personal data to provide products that match consumer needs is evolving, while simultaneously, consumers are learning to control access to their personal, social, and financial data. The next decade will be the age of the mobile device. More than that, multi-device, responsive user interfaces will allow users to manage their lives from anywhere and everywhere, regardless of access channel, so that it becomes lifestyle integrated. Alongside of this, a new type of socially responsible and ethical investor is emerging, one who shuns returns at all costs in favor of a more balanced approach, that of a fair and just return. However, the grave danger we face is a backlash from regulators, where they move from being passive to assertive to aggressive, whilst being unpredictable. This is being combined with the progressive restrictions on major APIs on the web, which could turn the new champions into forbidding gatekeepers. We must resist and fulfill the potential of this dream.
Okay. Great. Very well made.